No, not with the microphone.
No, we're going to hear this. Okay. It is now 3:31 p.m. I am now calling to order this meeting of the Other Post-Employment Benefits Trustees Committee. Val, would you like to take the roll call?
Yes, sir. Jeffrey Kirst.
Middle, this one, yeah.
Present.
Fran McGregor.
Present.
Mary Lamont.
Present.
Mark Mathers.
Present.
Also present, Robbie Carson, Jessica Young, and Valerie Phillips, Recording Secretary.
Okay, with that, we will turn to items under Section 2. We will accept public comments at this time. Do I have any public comments from the huge audience here today? Okay, seeing none. We will move on to item 2.01, approval of the minutes of the August 26, 2021 meeting. Do I have any changes or adjustments to those minutes? Okay, seeing none, I will accept a motion to approve.
Fran McGregor, I move that we approve the minutes from August 26th.
Do I have a second?
Mary Lamont, I second that.
Very good. We have a motion and a second. All those in favor, please say aye.
Aye.
Aye. Opposed? Hearing none, the motion passes unanimously. So now we move on to agenda item 2.02. This is for information and discussion only. You were provided an excerpt of our notes from our annual comprehensive financial report. And here to go over those is Robert Carson.
Thank you, Mark. Robert Carson for the record. So as Mark said, what you have is an excerpt from the district-wide annual comprehensive financial report. Every year the district is required to get an outside financial audit done on all of our financials. And in the past couple of years, the OPEB portion wasn't part of it, but this year it came back on. The notes section was still provided as a general information. We just didn't present financials in this report. But because of a change in reporting standards, we had to add it back on. So what we're providing here is our Note 9, which is post-employment benefits other than pensions. So it's our OPEB note, and it just basically gives you an overview of the three separate plans, the requirements for eligibility, the numbers of participants, and then also the amount of the benefits that are available for it. So those will be pages 70 through 72, I believe, down at the bottom. So really fun reading if you ever get curious. Really riveting stuff. If we go to page 73, this talks about actuarial methods and assumptions. So our OPEB liability that we report as a district and then for the OPEB trust is all determined by an actuarial valuation. So they make different assumptions based on expected life expectancy of the members, healthcare trends, prescription rebate trends, the discount rate that we use, and they forecast what the liability could be if, for whatever reason, we just stopped and we owed everybody this money at that time. So that's what this is just going through and explaining the assumptions that they use to calculate this liability that we report as a district. So I don't know if you had any time to read through any of that or if you have any questions on the assumptions that they use that I can answer.
Jeff Kirst, I just had one question, actually two questions on page 71 and 72, where it lists active employees under the WCSD RHP, and then on the life insurance one. It shows active employees. Are those the employees who are still working for the school district, but they would have been under the dates of employment noted in these
Yeah.
noted in all of the verbiage here.
Yeah, that's correct. So they're active employees who could potentially be eligible when they retire or if they retire from the district. So we just report that as a global amount of what could be coming up in the future.
Thank you.
All right. So then the other thing on page 74, we get past all the assumptions and the explanation of the discount rate. And page 74 and 75, what this does is break down the district's total OPEB liability, the plan fiduciary net position, which would be our actuarially determined value of the OPEB trust. So there's that, and then subtract out the net OPEB liability. And these are broken out into the 3 different plans. So we don't show it as a total. So we won't show the whole $82 million that we have in assets. It's broken out by proportion by plan. The other thing that goes into this is changes in assumptions that they made. And there were some rather large adjustments this year, which was nice because it brought our liability way down. So the biggest change, and you'll see difference between expected and actual experience on each of the 3 plans. On the bottom of page 74, under the WCSD RHP, there's a negative $40 million adjustment for differences between expected and actual experience. And that was the biggest portion of our adjustment. So the actuaries went through, they evaluated all the data, and they found that our prescription costs were expected to be much, much lower than the assumptions that we used before. So it brought our total OPEB liability down almost $80 million because there was such a huge decrease in prescription costs. So there were other minor assumptions, but that made up the biggest portion of it. So if you were to add all these up, our total OPEB liability went from $256 million at the beginning of fiscal year 21 to $183 million at the end of fiscal year 21. And then our net OPEB liability decreased from $197 million to $101 million. So again, a large portion of that was the decrease in the prescription rebate costs to be expected, and then also the performance of the OPEB trust with investment earnings. So we had, I think it wound up right around $17 million in gains, in just investment gains, and then we had $2 million of contributions that we did on behalf of the district. So the OPEB trust fund balance went up over $80 million, which was wonderful.
Can you go through that last part again, Robbie? I'm sorry.
Which part?
How did we end up with an $80 million better position?
Oh, so the $80 million better position, so we ended up with an adjustment to the assumptions.
Mhm.
So it was 40,
Oh,
30, 70. So it was an $82 million adjustment down in the assumptions. And then we had, well, roughly $80 million. And then we also had the $20 million gains that we saw for the trust for the plan assets. Do we have any questions on those 3 little tables before we move on? Okay. So then starting on page 76, the actuaries put together different sensitivity comparisons. So the first one at the top of page 76 is what our liability would look like with a 1% change in the discount rate used either way. So if our discount rate went down, then our OPEB liability would go up $31 million. If we were able to increase our discount rate 1%, then our liability would go down $34 million. So that plays a huge role in what we have to record in the liability. We were able to use a higher discount rate this year, again, because our total liability went down with those assumptions. So we were seen as more funded. So we were able to get a higher discount rate, which was great. The next little table is just a change in the healthcare cost trends rate. And again, 1% increase and 1% decrease. We don't have any increase or decrease with the life insurance plan because it's healthcare costs. So, and you can see what those do on that. And then the last little table, sorry, 2 more little tables. On page 77, this is the effect of this shows the deferred inflows and deferred outflows that pertain to the liability. And it just summarizes it by plan for the year, by each of the different plans for the year. So it comes in with the changes of assumptions and shows what our expected inflows and outflows would be throughout the years. And then finally, the last page the last table on page 78, this just summarizes this summarizes the OPEB expenses throughout the years and the expected going forward. So we have expected in fiscal year 22, our expected outflows for the health plan are $3 million. For the PEB plan, it's just under $1 million. And the life insurance plan, we're expecting to get back $1.1 million. Or maybe I'm reading that wrong. I am reading that wrong. I apologize. So for the health plan, the revenues are expected to be higher than the expenses in that plan and the PEB plan, and then the life insurance plan we're expected to outflow about $1.1 million. So those are the expected outflows going forward throughout this liability.
Thank you. Jeff Kirst. So the brackets are actually the opposite.
Yes, so
That's what I figured.
Yeah, so they would be, actual revenues would outweigh expenses. So I apologize for reading that wrong the first time. And so, like I said, this is just a summary of what we're looking at and how we came about the numbers that were reported in the financial statements at the end of the year. If you wanted to see the financial statements, I have many copies in my office. I'd be glad to share them. It's a fun read. So with that, I think that ends that portion of it. If you have any questions, again, I'd be happy to answer them.
Jeff Kirst, one question about the discount rate.
Yes.
With that discount rate, do you negotiate that, or is that, how is that actually determined? We were given a lesson in it at our last meeting, but I wondered if you negotiated or how it works out.
It's not negotiated. The actuaries determine it, and they use the 7.5% expected rate of return that PERS has for their Arbif, and then it's a proportion of our funding ratio. So again, had we not had the $80 million difference, then I think our original draft discount rate was somewhere around 2.4%, but because that adjustment, it showed us as more funded for the plan versus the liability, so we were able to get a much higher discount rate for it.
And so this is Mark Mathers. We kind of go into that on the top of page 74. So basically, the discount rate is a blended rate between the retirement benefits investment fund assumed return of 7.5, and then we're required to a fixed income rate based on what we would get on cash. And that's that bond buyer 20 bond GEO index of 2.16. So it's a blended rate between those two. And what I'm hearing from you is the portion of each is based on our funded ratio, basically.
Correct.
Yeah. If bond yields ever go up, Mr. Kirst, then that bond index number would also go up.
Jeff Kirst, and then the 7.5% is that negotiated, or is that also something that is determined by whom?
So that one's actually determined by the state of Nevada's Arbif investment board, and that's what they're shooting for. So their expected rate of return hasn't really changed much lately. They're still shooting for 7.5%. And if that one changes, it'll be done by the state, and that'll affect our discount rate going forward too.
Thank you.
Mm-hmm.
So, Mark Mathers again. So, this was an unusually good year in the sense that the net liability is almost half of what it used to be a year ago, based again on what you explained in terms of actuarial changes and just a comparison of the actuary to expected versus assumed kind of costs. And then also, a banner year in the investment portfolio. I think our return we went over last time was like 40%.
Yeah.
So you're not going to see this happen, but whatever, once every 20 years or something. But obviously, it's nice to see.
Jeff Kirst. Today, the Wall Street Journal had an article about pension funds and their possible liquidity crisis, that they've all moved their cash positions way down and gone into some of these investments, which PERS does not do, but the unusual type ones that may be illiquid. Who actually watches out for that in our state and with our fund?
So Robert Carson for the record. So these funds are all deposited with the state of Nevada with their retirement benefits investment fund.
PERS.
Yeah, so PERS actually manages all these. In terms of liquidity, we don't pull a lot of money out just because we're paying it on a reimbursement type basis. So unless something absolutely crazy happens, I wouldn't foresee any liquidity issues that we have with this.
Okay, any other questions or, okay. This was just for information and discussion only, so you're past the, well, no, you're not past the intense accounting discussion, because we now turn to agenda item 2.03. Again, for information and discussion only, but these are our first quarter for the fiscal year financial statements. And again, I turn it over to Robert Carson.
Thanks, Mark. Robert Carson for the record. So this is a tale of two different years. Like we talked about in the previous item, fiscal year 21 saw just unbelievable returns, and then FY22, you can kind of see it start shifting, and we're kind of coming back down to earth. So the first page on item 2.03 is the comparative statement of net position. So we have it presented as of September 30th, 2021 and September 30th, 2020. We didn't have any liabilities as of this time in either year, but you can see the total net position for 2020 was 67.5 million versus 82.5 million in 2021. So that, again, it's rolling over from the previous fiscal year with all the gains that we had at the end. The next page on there is the statement of revenues, expenditures, and change in net position. And this is where we get down into the details and we can see all of it. So under the revenue section, we have earnings on investments. They're pretty equal year over year, just a little bit higher in fiscal year 2022. The realized gain is up about $800,000. And this is the big change, is the unrealized loss or gain or loss that we had year over year. In fiscal year 2021, we had a $2 million unrealized gain. And in fiscal year 22, we had a $2 million unrealized loss. So that's just the investment performance coming back down to earth, which will affect our, net position in the end. Hopefully it kind of balances itself out and we don't lose too much in there. But again, it's a tale of year over year. The expenditures, we changed how we were accounting for certain things starting in the middle of last fiscal year. So you'll see $160,000 in retiree life insurance expenses in fiscal year 2022, but it's not there for fiscal year 21. In the next quarter, that's when we made the adjustment last fiscal year, so it'll be more comparable in the next meeting that we have. So again, the 67.5 million net position as of 2020 and the 82.5 million as of 2021. Those balance out to the next sheet, or to the previous sheet, sorry. So we have any questions on what's going on in either of these statements? Okay. If we flip over to the next page, so this is just a summary of the ins and outs in the Arbif account, which is our proportion of it. And it's presented as of the end of the quarter and then also the fiscal year to date. So as of September 30th, 2021, we had total changes to net assets of negative $2.5 million. And the biggest portion of that is, again, the change in unrealized appreciation. So the unrealized loss that we had was $2 million. Everything else is performing pretty well. And that's versus fiscal year 2021 year to date, we had $3.5 million gain, and a lot of that was attributed to the unrealized gain that we had. So again, hopefully it stabilizes and, you know, kind of comes back down and we're not losing millions of dollars every month, but that's where we're at and we'll keep an eye on it. So, and I'd be happy to answer any questions on those.
Okay. Our last item is 2.04, which is just a review of the investment returns for the Arbif fund for the quarter ending, or period ending September 30th.
Thanks, Mark. So the state of Nevada decided to update how they were doing this. It used to be one page, and now we get a 3-page report out of this. So the second page of this, it's labeled Rbif Performance, and this is similar to what we've seen previous, and it's showing fiscal year to date earnings based on the different categories, because you remember they shoot for, I think it's 50% stocks, 20% non-US, or 25% non-US stocks, and 25% US bonds. So the stocks are doing fairly well, not compared to historically, but they're still making some money. The non-US stocks are down 0.7% for the fiscal year to date, and the US bonds are pretty stable and not really yielding much. So the total Arbif fund, the net return is 0.4% versus the 15, the 20 that we were seeing every other quarter last year. So that explains the unrealized losses that we've been experiencing. The next 2 pages, I apologize, these are new to me, so I'm still kind of trying to work my way through them. And I think it's just showing trends again in a different way for the for fiscal year to date, last 3 years, last 5 years, last 10 years, and so on and so forth. And I'm not sure if Mark has anything to add to that. Like I said, this one's new to me, so I'm still trying to figure out where they're going with it.
Yeah, it looks like they're trying to compare us to some universe of pension funds or similarly managed funds, and you can see the blue dot that represents the Arbif fund, and those returns compared to, again, this universe of other public funds that they benchmark themselves to. And we've talked about this before, you know, they're in passive index funds. They don't have any management fees to speak of, and so that helps performance. And so, you know, we're outperforming, or we're in the top, looks like top 10th percentile of other public funds. So that's good, obviously.
Thanks, Mark. And the last page is just a scatter chart, and these are just the different arms of the state investments, from what I can tell.
Yeah.
So it's just showing the return for each of the different sections. So PERS is down pretty close to 8%, maybe a little under 8%. Everybody else is running much higher compared to the PERS investment. So just kind of giving you an idea of the different investments that they have.
Mm-hmm.
And that's all I really have on that one, too. So if you have any questions, I'd be happy to answer them.
Okay. We will take public comment, again, from the huge audience that we have. Val, you didn't receive any public comments online,
I
correct?
did not.
Okay. All right, you guys, this was a quick meeting. I appreciate you coming in and doing this. Our next meeting is February 24th, so happy holidays to all of you. And we are adjourned.